The Madoff investment scandal was a major case of stock and securities fraud discovered in late 2008. The perpetrator was Bernard Madoff, a former Nasdaq chairman and the founder of the Wall Street firm Bernard L. Madoff Investment Securities. According to the original federal charges, Madoff said that his firm had liabilities of approximately $50 billion US. Prosecutors estimated the size of the fraud to be $64.8 billion. Based on the amounts in the accounts of Madoff's 4,800 clients as of November 30, 2008, the Madoff fraud was a Ponzi scheme, meaning that Madoff used money from new investors to pay off old investors. He promised his clients steady returns, regardless of market conditions, and used a variety of methods to keep his scheme going. One method was to create fake trading accounts. Madoff would send his clients statements that showed their accounts were growing, even though no actual trading was taking place. He also used a technique called cherry picking, which involved selecting only the most profitable trades to show his clients. Madoff's scheme was able to continue for many years because he was able to maintain the illusion of success. He had a reputation as a successful investor, and his firm was well respected on Wall Street. He also used his position as Nasdaq chairman to give his firm an air of legitimacy. However, the Madoff fraud finally came to light in December 2008 when his sons Mark and Andrew turned him in to the authorities. Madoff was arrested and later pleaded guilty to 11 felony charges, including securities fraud, wire fraud, and money laundering. He was sentenced to 150 years in prison, where he died in 2021. The Madoff fraud had a devastating impact on its victims. Many people lost their life savings, and some even lost their homes. The scandal also led to a loss of trust in the financial industry, and it contributed to the global financial crisis of 2008. The Madoff fraud is a cautionary tale about the dangers of greed and corruption. It is a reminder that even the most respected institutions can be involved in fraud, and that investors need to be vigilant in protecting their assets. The following are some of the key takeaways from the Madoff fraud. Ponzi schemes are a type of fraud in which investors are promised high returns with little or no risk. These schemes are unsustainable and will eventually collapse. Investors need to be wary of any investment that promises guaranteed returns. It is important to do your research before investing in any security. You should also diversify your investments to reduce your risk. If you think you may have been a victim of a Ponzi scheme, you should contact the Securities and Exchange Commission, SEC, or your state securities regulator.